Welcome back, best ever listeners, and thank you for joining me on the Horizon podcast. This week, I'm going to focus in on what's happening with retail sales, how much people are spending, what they're spending it on, and what I think the trend will look like going forward. Of course, I will tie this back to how it's affecting commercial real estate at the end there. I'm Chang, and I've been active in real estate investing most of my life. And since 2007, I've led the research and advisory services team at Marcus & Millichap, the leading commercial real estate brokerage company. Now, I must mention, as I always do, that I am doing this podcast independently, and what I say on this show doesn't reflect the opinions or positions of Marcus & Millichap. So, before I dive in, I do want to share that I'm going to be out on the road a fair amount in the coming months and speaking at conferences. If you're out there, give me a shout. On September 3rd, I will be at the 2025 SSA Self-Storage Fall Conference at the Aria in Las Vegas. That is the 50th anniversary of the SSA. So I will be there. I will be speaking Wednesday, September 3rd at 8:15, giving a state of the self-storage market, together with my friend and partner, Stephen Weinstock, who heads up the self-storage division for Marcus & Millichap. On the 4th of September, I will still be at the ARIA, but I will be speaking at the Western CREF event, which is held by the California Mortgage Bankers Association. I'm on at 9 a.m. and my topic will be, has the commercial real estate investment market turned the corner? In October, I will be in Seattle on October 16th for the Pacific Northwest Multifamily Forum. And on October 30th, I will be in Dallas for the Texas Multifamily Forum. So those are a few of the things I'll be speaking at. I'll be doing some smaller events as well, but those are the big ones that people might find me at. Again, if you see me there or if you want to say hi, please come up, say hello. I'd love to talk to you. So, next thing here, what's happening with retail sales? And this is important. We have to remember that consumption, which includes the sales of both goods and services, constitutes about 68% of the economy. Services sales are the bigger part, about 45% of GDP, whereas goods, which is basically retail sales, is about 23% of GDP. So basically, I look at retail sales because it represents about a quarter of the U.S. economy. And it's a good sign of what's going to happen with some types of commercial real estate, but also what's happening in the broader economy as a whole. So I'll dig into some numbers to start out. The July retail sales numbers came out August 15th. The headline retail number was up 0.5% month over month and up 3.9% year over year. And that's on a nominal basis. And that was stronger than people expected. You're seeing that number in the headlines, and basically people are saying, hey, that was better than we expected. So that's pretty good. But you also have to, and you don't see this out there very much, but we inflation adjust our retail sales numbers, especially over the last few years with the high inflation rates that we've been experiencing. So on an inflation adjusted basis, retail sales were up 0.4% month over month and up 1.2% year over year. So the numbers shrink a bit when you start looking at an inflation adjusted basis. It's still good, but not great. Basically, if you look back at the trend on an inflation adjusted basis, retail sales have basically been flat since March of 2021. And in today's dollars, they're hovering in the range between about 710 billion, and 735 billion. And the most recent reading was 726 billion. So it's been in a pretty narrow band, all things considered, for the last couple of years, actually last 4 years, 4.5 years. The economy from a retail sales standpoint has basically been treading water. And so it's, again, they're good numbers, but they're not great. We're not seeing upward momentum in retail sales. And so that's a little bit concerning over the long term. And if you toss out autos and gas, it's basically core retail sales. We leave food in the mix for our numbers because we look at what's happening with grocery so much. So our core retail sales omit autos and gas. Those are up to 0.2% month over month and 4.4% year over year on a nominal basis. And inflation adjusted, they were flat month over month and up just 1.3% year over year. So core retail sales, again, treading water. They're just really not moving much, been basically flat for years now. And all things considered, this is pretty good, right? I mean, at least we're not going down. And when you consider the weakened employment market, right? We just had that 258,000 job revision. We pulled basically 258,000 jobs out of the total for the year. We see rising long-term unemployment. We see the impact of the tariffs starting to materialize. We see rising debt levels, right? That's in the news a lot. They keep talking about how debt is at an all-time high. So if you look at the numbers, household debt is at a record $18.4 trillion, up 3.3% on a year-over-year basis. That's a lot. Mortgage debt is also at a record $12.9 trillion, up 3.3% year over year. Auto loan debt at a record $1.7 trillion, up 0.7% year over year. Credit card debt at a near record $1.2 trillion, up 5.9% year over year. That's the numbers you hear in the news. That's where they come out and say, retail sales is going to be in trouble because debt is at a record level. People are going to face more headwinds. Credit card delinquency rates are up. That's true. But we're not looking at the whole picture at that point. We're talking about debt, how much people owe. And that's up. That's at a record level. But earnings continue to rise as well. Wage growth is averaging 4.4% right now. So if you start factoring the income, right? So you're not just talking about debt. You talk about debt to income. Now you get a different picture. Household debt as a percentage of income is 61%, which sounds a little high, but then think about this. The 10-year average is 63.8%. So currently 61%, 10-year average 63.8%. And back in 2007, the household debt to income ratio was 82%. So much lower than it was in 2007, lower than the 10-year average. So when you factor the income in, it makes a big difference. Yes, people have more debt, but they have more income as well. So debt to income percentage is about 61%. Mortgage debt as a percentage of income, 43.2%. The 10-year average is 44%, so we're a little bit lower than the 10-year average. And back in 2007, mortgage debt as a percentage of income was 60.4%. So we're way lower than we were in 2007, and we're a little bit below the 10-year average on our mortgage debt. Auto loans. We keep hearing about bad auto loans, that people are defaulting on their loans. And, for some segments of the income spectrum, yes, this is a problem. People got out over their skis. They bought cars that they couldn't afford. That is a problem. Auto loan debt as a percentage of income. Now I'm looking at a macro here. This is national and it gets skewed to a degree by, high earning people, but auto loan debt as a percentage of income, 5.5%. 10-year average, 5.9%. It was 5.6% in 2007. So auto loan debt is not out of alignment with historical trends. Credit card debt as a percentage of income, 4.0%. 10-year average actually is a little bit lower. So we are pushing the credit cards a little bit more than normal, quote unquote normal, 10-year average, 3.8%. So we're at 4% today, 10-year average, 3.8%. But back in 2007, it was 5.5%. So, all things considered, kind of, you look back, the reason I picked 2007 was because it was kind of a height of that last cycle before the financial crisis when people were getting out over their skis with debt. And so it's kind of a good benchmark. People were spending, way too much. And I'm highlighting that it's much more under control at this point when you factor in income levels. So, even though the absolute debt numbers are really high, when you factor in the income, the debt as a percentage of people's earnings, they're lower than what you might think, and they're still relatively low by historical standards. And so I would say that debt levels really aren't a problem on a macro basis, right? Again, there are segments of the population where they are out over their skis, where they do have more debt, where they can't afford the debt that they've brought on themselves. And that is a problem. Generally, that's the lower income, quintiles, that are facing those headwinds. If I could find it, I would get more granular information for different income segments, but all I can find are the macro level numbers, and they don't have breakouts by income tranche. So, can't quantify it. I believe that is true. I can't prove it. Maybe there's numbers out there. If somebody knows what they are, send them to me. I'll be happy to look at it and refine this perspective a little bit more. So basically, on a net basis, consumers have the resources to continue spending. I had something up here also. Total savings, including money market accounts. Remember, a lot of times the economists will cite the savings amounts, and those have been trending lower. But part of the reason they were trending down was because people were moving their money out of savings accounts, which pay basically no interest, and moving the money into money market accounts, which pay some interest. And given the higher inflation, that was a better place to be. The interest rates are higher. If you're going to put some money, stash it away, still want it to be very liquid, you put it in a money market account. So that's why I provide a combined savings plus money market, as opposed to just looking at the savings numbers, which tells you a different story, but it's missing part of the equation. So if you look at what's happening with savings, including money markets, it's up 4.3% year over year on an inflation adjusted basis. That's not nominal dollars. That's inflation adjusted, up 4.3%, to $25.9 trillion. So, that's up. It's about 8% below the peak set in 2021, at the very end of 2021 when stimulus checks were going out. So it's down a little bit from the all-time peak, but it has been trending up for about 2 years now. And so you have a lot of money put away. So again, the resources are there. The income is there. The savings are there. The debt to income ratios are not so severe that people need to pull back. So could retail sales continue to grow? The answer is yes. But the question is, will consumers continue to spend, right? So you can have the money, but if you're concerned about the economy, if you're concerned about the future, you might not want to spend it. You might want to save it. So consumer sentiment is down 5% on a month over month basis. That also just came out on, I think the 15th of August. And so we have consumer sentiment down. It came in at 58.6. That's above where it was in April and May when it fell like a rock after the Liberation Day tariffs were announced. So it did recover some, but it has turned and started to go back down again. And a big piece of that is tied to uncertainty. A big piece of it is tied to what's happening with tariffs and the expectation based on the consumer sentiment survey that inflation will hit 4.9% next year. Now, are consumers a great predictor of inflation? Probably not. In that case, I would lean towards the experts and what they're saying. They're saying 3.5 to 4. But perception is important. If people think prices are going to keep going up and they're going to go up more aggressively, they have a different perspective on what they're going to do with spending. Also, there's the tariffs. They're raising the uncertainty level. That's part of what's weighing on consumer sentiment. And I think that a lot of consumers are still front loading their purchases a little bit, getting a little bit ahead, maybe making holiday purchases a little early this year, before the true impact of tariffs hits the market. And so we're likely seeing a little bit of a boost. I know that back to school sales were shifted forward. A lot of the retailers were trying to push back to school sales, basically as the kids were getting out of school, because they weren't sure that the consumer would stay in the game all the way up until the start of the school year. But we're still seeing a little bit of pull forward. And so that suggests that we may see some softening in the retail sales over the fourth quarter of this year. We are seeing some slackening in specific areas, electronics, building materials and home improvement sales. Restaurant and bars sales have eroded a little bit over the last month. Apparel is still up. So is furniture. Grocery sales are up. Internet sales are up. But if more tariffs, if the cost of tariffs are passed through to consumers more than they have been, that is going to start to cause some issues, I believe. Now, Goldman Sachs chief economist did come out, I guess it was a couple weeks ago now, and they estimated that businesses have been soaking up the majority of the tariffs so far. They said about 64% of the tariff costs have been absorbed by companies, with only about 22% of those costs being passed through to consumers. And the Goldman Sachs report went on to say that over the next several months, and that's quote, I just grabbed that straight off of their chart, over the next several months, consumers will absorb a greater portion, rising to 67% of the cost from tariffs being picked up by consumers. Businesses are going to start passing it through. So businesses have eaten about 64% of the tariffs so far, according to Goldman Sachs. That's going to drop from 64% to 8% based on their prediction. And as a result, those costs are being passed on to consumers more and more over the coming months. And that will drive up costs. That will weigh on consumer sentiment. That will drive inflation. And so consumers may pull back at some point. And again, I'm looking at, maybe sometime in the fourth quarter. I had been anticipating more inflation to be showing up by now. I did expect to see some more inflation impact in the July CPI report. It didn't show up there. It did show up in the producer price index. And that just reiterates that companies have been soaking up those costs. But again, as we go forward, we should expect inflation to continue to trend higher based on the impact of the tariffs. So what's all of this mean for commercial real estate? And so for apartments and office properties, I don't see a real impact from retail sales. I mean, there's some, it could affect things on the fringe, but you're really not going to see a huge impact. So for this, I'm really going to focus in on industrial and retail properties for the most part. because they're going to have more direct impact from what happens with consumption and retail sales, especially imported goods. So industrial property demand could soften over the coming quarters. And I suspect this will be seen, it will be more apparent in Western markets that are more reliant on trade with Asia. And the reason, of course, is the tariffs and the trade policy and the, quite frankly, the erratic trade policy that we've been dealing with, when it comes to China and many of the other countries out there. So tariffs on China at this point, it varies by product, right? There's different tariffs on different things, but using the information from Yale Budget Lab, the net effective tariffs on Chinese goods, and that's when you kind of take the tariffs on each product, line by line, and weight them based on how much trade we're doing in different products. The net effective tariffs on products out of China right now is 27.9%, according to the Yale Budget Lab. Now, that could change. The trade negotiations are ongoing. The new deadline has been punted several times now, but the new deadline is November 10th. That's when we will, that's the deadline for more, for some sort of a trade deal to be made. Like I said, that's been punted a bunch of times. We don't know what it's going to be. The tariffs on India, are running at 50% right now. Those were just hiked, recently. And, again, that could be lowered at any given time. Vietnam, 20% tariffs. Japan and South Korea have negotiated deals at about 15%, tariffs on products from those countries. So the tariffs on products from Asia are higher in general, than what we're seeing elsewhere. And so I'm thinking the West Coast markets are going to feel more of a disruption from the tariffs than the East Coast ports. The European Union has negotiated 15% tariffs, which are the same as Japan and South Korea, but I don't think anybody's being hit like India and China are right now. So more impact to industrial on the West Coast markets. We've already seen some softening in those markets. So far, year to date, Los Angeles vacancy rates for industrial are up about 30 basis points to 6.7% in the second quarter. The Inland Empire, Riverside, San Bernardino, otherwise known as Riverside, San Bernardino, that is kind of the big warehouse market for the ports of LA and the port of Long Beach. Their vacancy rate is up 50 basis points to 8.3% in the second quarter. And remember, there was a lot of construction in the Inland Empire, so that's driving part of that. But that construction was based on anticipated demand that isn't materializing because of the tariffs. So vacancy in Inland Empire up 50 basis points. San Diego up 110 basis points so far this year, to 10.4% in the second quarter. Seattle up 80 basis points to 9% in the second quarter. Conversely, if you look at Eastern markets or a couple of the transshipping markets, Northern New Jersey, industrial vacancy up only 10 basis points so far this year to 6.1%. Dallas-Fort Worth has been flat at 9.4% industrial vacancy. Chicago up 30 basis points to 6.2% vacancy. So the U.S. as a whole, the average for the U.S. industrial vacancy rate is up 40 basis points so far this year to 7.6%. So basically my point here is industrial is being impacted by the trade policy, and the West Coast markets are going to feel this more so than the Gulf Coast or Eastern Coast, or the transshipping markets in Chicago or Dallas. And I will admit I did cherry pick these a little bit. They are some of the biggest industrial markets in the country, but I also, was really wanting to highlight key movements. I think in Denver had a lot of increases in their industrial vacancy rate as well, and several other smaller markets. But, basically, if you're going to make a bet, vacancy rates in Western markets are going to be impacted more by this than Eastern and Central U.S. markets. The good news is construction vacancy has been declining. So that's going down, and that is a positive. Now, for retail property, we've already been seeing a softening in retail even before the tariff hit. In the first quarter, at the end of 2024, the retail vacancy rate, overall retail, that includes single tenant and multi-tenant. The overall retail vacancy rate was 4.5% at the end of 2024. At the end of the first quarter, it was up 20 basis points to 4.7%. At the end of the second quarter, it was at 4.9%, another 20 basis points increase. I looked on a metro by metro basis, and pretty much, not every market, but this is pretty broad based. It's affecting most of the markets to some degree or another all across the country. Quite frankly, retail has been outperforming. The vacancy rates hit a record low last year, and they've been ticking up a little bit at a time. But when I look forward, I think more retailers may begin to slow play their expansion. Now, there's always churn in the retail market, right? There's always somebody who's closing a store. Again, Walgreens closing a lot of stores. There's a lot of retailers who are shrinking their footprint. And historically, or the last few years, we've seen new retailers coming in to replace them. But if more retailers slow down their expansion plans, we're going to see those vacancy rates drift up as vacancies are not replaced as quickly. Specific segments, grocery should continue to perform. Although the inflation pressures on food is increasing, but those rising food costs are going to impact restaurants more than grocery stores. And also restaurants are being impacted by labor shortages and rising wages. So, restaurant demand has been easing a little bit, whereas grocery demand has been rising. And when I say, restaurants is easing, mostly it's not going up as fast as it was, right? It's not a real negative trend. But it is not rising as quickly as it was, whereas grocery store sales are gaining momentum. But I do want to make a side note here, kind of off topic, but reductions to the Supplemental Nutrition Assistance Program, the SNAP program, those benefits were reduced by the new tax rules and the new budget. And so retailers in some areas that are more reliant on SNAP program sales may see a little bit more of a headwind than grocery stores in more affluent areas. Restaurants. Okay, so restaurant sales are down 0.6% month over month, but they're up 2.5% year over year. But as I mentioned, labor costs, rising food costs, those are going to start to have an impact. Those prices at restaurants are starting to rise, and I'm starting to hear a little bit of a pullback on people going out to restaurants and favoring cooking at home a little bit more as we go forward. Necessity-based retail will likely hold up well. For example, medical retail, doctor's office, dentist's office, eye doctors in retail centers, they'll be just fine. Those fall into the necessity category. Activity and entertainment retail. I think it's going to depend on the economic target of the individual center and those individual properties. So economic momentum, is going to play a role. Location will play a role. Some will be fine. Some will take some headwinds. But again, retail has very limited construction in the pipeline. So net retail should continue to behave itself and perform relatively well over the longer term. So just going into a review here, retail sales have been sturdy, but they're not really increasing. They could potentially hang out there and hold fast. The money is available. The resources to continue to drive retail sales is there, but I think the sentiment is weakening and caution is rising. And in that climate, people are less likely to spend that money. So we could see a slowdown of retail consumption, retail sales, going into the fourth quarter. But for commercial real estate, the overall outlook, it still remains sound, right? Some impact on some parts of industrial, some impact on some segments of retail, but in general, retail and industrial have long-term grit that will play through. Looking at the horizon as I focus on wrapping up here, we got to remember the cycle we're in will end. This is temporary. The elevated uncertainty, the impact of trade policy, the tariffs, the erratic policy that we're contending with that is driving the uncertainty, this will come to an end at some point. The economy is still sound. Although recession risk is rising, the economy still is enormous. And even if we lose a little bit of traction, we go into a light recession, I don't think the overall impact on the commercial real estate market will be that significant. Also, remember, over the longer term, you have 72 million millennials out there. They are entering their prime earning and their prime spending years. And that is going to continue to drive consumption and retail sales over the next decade. Baby boomers still have a tremendous amount of wealth, north of $80 trillion that is out there. That will continue to fuel economic growth, and that will continue to fuel retail sales and the retail segment of the economy and commercial real estate. Commercial real estate vacancies are still very low by historical standards, except office, but commercial real estate, industrial, retail, multifamily, medical office, pretty much everything has still very low vacancy rates by historical standards. Hotels have softened a little bit in recent months as well. But again, structurally, commercial real estate is well positioned. And remember, it is one of the asset classes that have the most resistance to recessions and the most resistance to inflation. So those are both positives, even in a worst case scenario. Current cap rates are elevated and commercial real estate transaction activity has been on the rise. And if you caught my podcast last week, I think that will continue. I think we have a lot of reasons why more commercial real estate transactions will happen in the second half of this year and going into 2026. Even if we slip into a very mild recession, there's just too much capital to place, too many reasons for deals to take place. Also the tax benefits with the accelerated depreciation. So anyway, I still think commercial real estate is one of the best places to invest right now. I think the stock market is going to remain volatile. I think bonds are still volatile. I think commercial real estate will be much less volatile, and it has built-in structures to help it withstand any recession or inflation that we encounter, or any soft and mild recession. Global financial crisis, commercial real estate, it was impacted, but there was a liquidity freeze that really had a big impact there. Anyway, I'm wandering. So let me wrap this up. Thank you for joining me, best ever listeners, for the Horizon podcast. Remember to like, subscribe, follow this podcast, please. It does help. And I will be back next Sunday and every Sunday with real estate insights to help you understand what's really going on in commercial real estate. I'll see you next week. And as always, keep your eyes on the horizon.